September 15, 2008. Before sunrise, America's financial heart skipped a beat. Lehman Brothers collapsed. A 158-year-old Wall Street titan erased overnight. Phones rang without answers. Traders froze. Markets trembled. And for the first time in generations, a terrifying question surfaced. What if the system itself fails? Not a company, not a bank, the system. To understand the collapse, we have to go back to the boom. In the early 2000s, America believed a beautiful lie, that housing could only rise. Interest rates were low, credit was easy. Homes were selling so fast that the ink barely had time to dry on the deeds. Banks approved mortgages for almost anyone, even borrowers with unstable income, with no assets, with no jobs. These were called subprime loans. But Wall Street didn't see danger. It saw opportunity. Those risky mortgages were bundled together, turned into complex investment products, and sold across the globe. On paper, they looked safe, AAA rated, the gold standard. In reality, they were stacked uncertainty, like building a skyscraper on soft, shifting sand. Here's how the machine worked. Banks issued mortgages. Investment firms packaged them. Rating agencies stamped them secure. And investors bought them for steady returns. Money flowed through the system like oxygen. As long as home prices kept rising, the machine hummed. Everything appeared stable. But markets do not rise forever. When housing prices slowed, the defaults began. Homeowners stopped paying. The cash flow feeding those multi-billion-dollar securities, it dried up. Suddenly, the world's most powerful institutions were holding billions in assets that nobody could value. Fear replaced confidence. And in finance, confidence is everything. Without trust, banks stop lending. Without lending, businesses stop expanding. Without expansion, the economy contracts. The oxygen was being sucked out of the room. Then came the breaking point. Lehman Brothers filed for bankruptcy. Markets didn't dip, they plunged. Credit markets froze worldwide. Even the most stable institutions feared they were next. For one brief, harrowing moment, the global financial system stood on the edge of total paralysis. This wasn't just a recession. This was systemic shock. The engine of capitalism stalled. The U.S. government intervened. A $700 billion rescue package. Emergency Federal Reserve action. Liquidity injections. Interest rates slashed to zero. The system stabilized. But the cost was immense. Millions lost their jobs. Millions lost their homes. Retirement savings evaporated. Trust in Wall Street was shattered. New regulations followed. Oversight increased. Banks were forced to hold more capital to prove they could survive a storm. But something deeper had changed. The illusion of invincibility was gone. The crisis revealed a powerful, uncomfortable truth. Modern finance is deeply interconnected. Banks, governments, markets, and your household. Pull one thread, and the entire fabric moves. The system survives not because it is unbreakable, but because confidence is restored again and again. History teaches us this. Every boom carries hidden fragility. Every surge in optimism hides unseen leverage. And every financial citadel has pressure points. So, we leave you with the question. If another financial shock hits tomorrow, is the foundation truly stronger? Or is it simply more complex? Comment below and subscribe to the Economic Citadel for more deep dives into the architecture of economic power.